All right, let's just dive right into this explainer and see if we can't untangle the massive contradictions that are completely defining today's global market. Seriously, if you've been glancing at your portfolio lately or even just skimming the financial headlines, you've probably felt a deep sense of whiplash. We are living in a moment where the standard economic rules seem to be bending, if not breaking entirely. And that is exactly what we are going to make sense of today. What's happening right now is a strategic synthesis of three massive forces colliding all at once. We've got escalating geopolitical risks crashing headfirst into highly polarized consumer data. And all of this is happening right as the global AI trade rapidly pivots its architecture. You just can't analyze any of these in a vacuum anymore. They are completely bleeding into one another. So to get a handle on all of this, we're going to navigate through 5 distinct macro zones. 1. Global choke points and risks. 2. The consumer spending paradox. 3. Hitting the AI capex wall. 4. Building the intelligence moat. And finally, 5. The summer mandate. Let's get to it. Section 1. Global choke points and risks. We're going to see exactly how physical world blockades are fracturing that market complacency we've all gotten way too used to. We absolutely have to start with physical supply chains, specifically the Strait of Hormuz. Between a reinstated U.S. naval blockade and a steep 20% maritime toll being demanded for non-Iranian cargo ships, we're looking at an absolute logistics freeze. Commercial crossings literally dropped a staggering 52% over a single weekend. I mean, we went from over 100 crossings a day pre-war down to just 12 observed on a recent Sunday. And the impact on asset pricing? It's intense. Brent crude is surging over $80 a barrel, and a critical 120 million barrels of flow are actively threatened right now. So naturally, energy sectors are outperforming, up over 3%, while vulnerable sectors tied to fuel costs like European airlines are taking immediate and heavy hits. And this scale really brilliantly illustrates the geopolitical reality behind the scenes. We hear so much about the public facade between Russia and China, right? The mutual defense posturing, the staged optics to protect this perception of parity, this whole idea of a no-limits partnership. But the on-the-ground geopolitical reality is that President Xi is extracting massive concessions across energy and regional development banking. It's gotten to the point where foreign policy experts are now describing Russia's trajectory as vassalage. They are essentially converting what was a former equal partnership into a state of strictly managed subservience. All right, Section 2, the consumer spending paradox. Moving from global waters to domestic wallets, we hit an economy that honestly simply doesn't make sense on the surface. We're dealing with a deeply conflicted consumer base. This famous quote by F. Scott Fitzgerald, it perfectly encapsulates the exact mindset we need to unpack the massive contradictions in today's consumer behavior. To truly understand the data coming up, you have to be comfortable holding two deeply opposed realities in your mind at the exact same time. There is a massive disconnect happening. On one hand, we have a total sentiment collapse. The University of Michigan reading is sitting at a consensus of 51.5. To put that into perspective, sentiment has hit historic, post-1952 lows. People are feeling objectively worse about the economy right now than they did during the dot-com bust, the great financial crisis, or even the absolute depths of COVID-19. Why? Because they are just exhausted by a 33% cumulative inflation over the last few years. But then, there's the spending engine. Despite being historically depressed, retail sales are still notching consistent month-over-month growth. Consumers are somehow, against all odds, continuing to absorb these higher prices. So what we're really looking at here is a tale of two wallets. You just cannot look at the consumer as a single monolithic entity right now. High-income consumers, they're acting as the buffer. Their household cash balances remain about 33% higher than pre-pandemic trends, and they're out there actively spending capital gains from a 4-year stock market bull run. They're absorbing higher structural costs for housing and insurance without curbing aggregate demand at all. But on the flip side, low-income consumers are enduring a severe squeeze. Emergency funds are entirely depleted, savings rates have plummeted to multi-year lows, and wages are just flat out failing to outpace that 33% cumulative inflation. And this low-income squeeze is forcing some massive corporate pivots. Companies are literally slashing their marketing budgets entirely just to keep vital consumer goods strictly under this exact number, $9.99. This is the new psychological pricing threshold. Once an everyday item crosses that $10 mark, that squeezed demographic simply walks away. Moving on to Section 3, hitting the AI capex wall. Let's pivot over to the digital world and explore how all this macro volatility is threatening the massive capital currently being spent on artificial intelligence. We can actually see a direct volatility transmission mechanism here, linking our first two topics right into tech. We like to call this the Korean barometer. South Korea imports 70% of its oil from the Middle East. So when that choke point escalation spikes oil prices, the South Korean Kospi Index and massive tech companies like SK Hynix see their volatility index completely spike to 84. That implies daily moves of over 5%. Now, why do we care? Because South Korea holds memory chip supply chain dominance. So when they experience extreme swings, like a 19% drop at the onset of a conflict, it bottlenecks the entire US tech and AI trade. We might have these lofty expectations of over 60% infotech earnings growth, but the harsh reality is the Magnificent Seven and the broader semiconductor indexes are essentially held hostage to these highly volatile overseas chip markets. To truly understand the risk tech giants face right now, I want you to think about Major League Baseball payrolls versus incremental wins. On the low end of the spending scale, you have the value play. Teams like the Tampa Bay Rays who spend relatively little but get a high yield in wins. But way on the high end, you have the capex trap. Think the New York Mets. The Mets surged their payroll to historic highs, but what happened? They experienced a negative Sharpe ratio, meaning their risk-adjusted returns actually plummeted. Basically, spending massive amounts of capital rapidly to acquire proven superstar assets yields severely diminishing marginal returns. Each additional dollar you spend buys fewer and fewer actual wins. And that logic? It maps perfectly to the AI hyperscalers of today, companies like Microsoft, Meta, and Alphabet. These guys used to be beloved by the market because they were asset-light tech darlings. But look at their trajectory now. They're transforming into heavy capex infrastructure plays. The warning here is glaring. Bidding up superstar assets in AI, throwing billions at data centers and raw compute power leads to peak multiples and essentially guarantees diminishing returns for late-stage investors. Rapid asset growth in corporate equities historically produces inferior long-term returns. We are hitting the capex wall. Which brings us to Section 4, building the intelligence moat. Since we clearly can no longer rely on raw spending for market dominance, how do we actually find the companies that will thrive? Well, we have to transition away from tangible assets and simple ecosystems and step firmly into the era of Value 4.0. You know, classic value, the old Graham and Dodd methodology, focused on tangible assets, book value, present-day cash flow. Then, Value 3.0, the Amazon model, was all about depressing near-term profits to build inescapable platform ecosystems. But Value 4.0, which is based on the Psi Capital framework, demands that we evaluate companies by looking 5 years out at their proprietary data advantages, completely ignoring the noise of current multiples. The absolute key to survival is finding companies that are actively building this continuous, self-sustaining loop. First, they establish an intelligence-based moat. That's a barrier to entry built entirely on proprietary, non-replicable data. Think of Tesla's massive vault of full self-driving data or CoStar's commercial real estate data. Next, they use that data to produce scalable AI-driven digital labor as their core offering. Third, they maintain a highly profitable core business that funds all this massive AI R&D without loading up on a ton of debt. And finally, they deploy that capital right back into the intelligence engine at compounding rates of return. You really have to realize that emergent AI players only have a 1 to 5% likelihood of actual long-term success. The core philosophy here is to diversify over high-quality businesses and deploy capital only where competitive advantages are absolutely unassailable. You essentially have two safe zones. The first is the cloud toll roads, the AI infrastructure players like Amazon, Google, and Microsoft. The thesis is super simple. No matter who actually wins the AI software race, the compute and data must flow over these three providers. The second zone is the deep moats, specialized long-term bets. This means entities like SpaceX, CoStar Group with its amazing 60 straight quarters of double-digit revenue growth, or QXO, which is a decade-long horizon bet on management. Finally, Section 5, the summer mandate. Let's pull all these complex crosscurrents together to secure your portfolio. You must abandon companies aggressively throwing capex at AI just to get a short-term narrative bump in their stock price. It's a trap. Instead, follow these 3 strict mandates to secure your portfolio. Number 1, hedge the choke points. Do not expect a return to the pre-war norm. Baseline inflation and supply chain frictions are structural now, not transitory. 2, tolerate the paradox. Ignore the bleak sentiment surveys and just follow the wallets. The high-income liquidity is bridging the gap, but heavily monitor that $9.99 pricing threshold as low-income buffers vanish. And 3, demand the moat. Shift your allocations strictly to Value 4.0 entities wielding proprietary digital labor. So I want to leave you with this provocative thought to deeply consider as you evaluate your own assets. Is your portfolio built for a Value 2.0 world, or is it armed with the intelligence moats required for a Value 4.0 reality? Take a really hard look, because surviving this summer of contradictions depends entirely on your answer. Thanks for joining me on this explainer. I'll catch you next time.